So I receive many great questions here on my channel about investing for dividends and cash flow. And one of the questions that's been coming through quite a bit is, hey Ian, how do you decide which particular stocks to purchase? At a given time, a given point in time, you own 37 stocks in your portfolio. How do you decide of that 37 which one to buy? Or maybe it's not even part of that 37, maybe you want to add a net new position. How do you decide what to do at any given time? This is a great question, and this is the topic of today's dividend investing video. Hey everyone, thank you for being here. Another wonderful subscriber question. Thank you for the questions. Please keep them coming. And just before we get started in the video today, if you like my channel, subscribe, ask questions, it really, really means the world to me. Thank you so much for that. And so I want to answer this question because it's a really important question. And before I even do, I want to talk about two different buckets of investors. There are two types of investors. There are investors who have a new portfolio, who are just getting started out. And then there are investors like myself. They've been in the game for a long time. They have an existing portfolio of dividend stocks, and so they have an established portfolio. When one has a new portfolio versus an established portfolio, I approach those two situations completely differently when adding new stocks or buying stocks in the portfolio. And so I've done a bunch of videos here. I'm going to link in the description below of hypothetical scenarios. If I had a brand new portfolio with $1,000, $5,000, $10,000, $25,000, or $50,000, how I would start out. And in general, one of the general themes amongst all of those portfolios is I go straight to the quality. I like to add core positions, those positions that are the most important positions right away. They're the ones that I like. They're the ones that I envision providing the lion's share of dividends in the long run. I like to add those right away. And I'll generally do that as long as the valuation is somewhat reasonable. I don't try to necessarily time the market. I don't try to look for deep value. I don't wait until they're on sale. I just like to get the snowball going. And so as long as the PE ratio, the valuation is reasonable, somewhat reasonable, I will start averaging in. Now, obviously, I will not make a lump sum purchase and deploy all of my money at once. I will typically average in over time, and this differs as the portfolio gets bigger. So with the $50,000 portfolio, hypothetically, that one I average into slower. The $1,000 portfolio, I probably just go ahead and get started just to get the ball rolling. But certainly I keep an eye on dollar cost averaging over time into core quality stocks and just getting things moving in this hypothetical scenario of a new portfolio. Let's talk about my personal situation though. I personally have an established portfolio. I own 37 positions. And so this portfolio has been around a while. I've been investing in dividends for over 20 years, and things are a little bit different when one has a more established portfolio, or at least in my personal situation. In my portfolio, before I get started on anything, I like to just think about what types of stocks I own. I own core stocks, I own medium and small. I'm going to link in the description below. I have another video that talks about the specific composition of my portfolio and how I think about core, medium, or small. On average, a core position is about 4.59% of the total in terms of dollars. The average medium position is about 2.21%, and the average small position is about 1.32%. You add them all up, it's 100% of the dollars that I have in my portfolio. And before I even get started with my strategy of what should I buy next, I just like to think, are the stocks in the right place? If I envision a stock being a core stock, is it a small stock right now in terms of its dollar value? Well, that means I have some work to do on that stock. I need to bring it up to size. Or conversely, is a stock that I never envisioned being a core stock a huge position in my portfolio, and maybe it got ahead of itself, maybe the stock just did really well and it grew really quickly? I like to think about those scenarios as well. And so before I even start thinking, what should I buy next? The first thing I like to do is just assess what are the positions that are in my portfolio. What should they be in the ideal case? Should they be core, medium, or small? And are they actually in that situation? Are they where they should be? Because if they're not, there's some work that needs to be done to bring them into the right size. And so I just think about that at a high level. And then basically I get into these four pillars. I have 4 pillars that determine how I purchase, what I should purchase at any given time. And I'm going to link in the description below. There are 2 stocks in particular that are part of my strategic themes for 2018. Those are Procter & Gamble and Kimberly Clark. And so strategic theme number 1, or pillar number 1, I put $5 signs next to this. This is the biggest bucket by far. When I am buying stocks any given year, I like to follow a plan. I like to follow a charter that I set forth at the beginning of the year. And if you've been following my channel, again, I'll link in the description below. My strategic theme this year is Procter & Gamble and Kimberly Clark. The reason that those 2 stocks are so strategic for me this year is they're core positions. They're already in the core bucket, so I don't need to necessarily move them between buckets. They're already really big, but I want them to be even bigger. Yeah, they're in the core bucket, but I want them to be bigger. Also, I believe that they're deep values right now, so they're trading at reasonable valuations. The starting yield is really good. And so for my portfolio, out of the universe of stocks that I own, and I am kind of biased about bringing net new positions in just because the portfolio already has so many positions and it's already so diversified. Out of everything I own, these are the 2 stocks that I decided to work on this year. And so as the year progresses, 2018 progresses, I don't want to lose sight of this. Sometimes when one is investing, one can become emotional. One can see, oh, something is going way up or way down. One can hear the media, the noise out there. It's hard to stay focused. And so in my particular situation, by setting a strategic theme and then staying true to it, writing it down, keeping it on paper throughout the year keeps me focused. It keeps me a little bit less emotional than I might have been otherwise in the investing game. And so again, bucket number 1, $5 signs throughout this year. I will keep following my strategic theme, and I will keep following it until these particular stocks just are not attractive anymore. They're maybe they go way up in price, maybe things change. As long as they are in that buy zone and I feel comfortable buying them at current valuations, I will keep adding to my strategic theme. So that's pillar number 1. That's where most of my money is going to go this year. And that's a yearly practice that I like to get into, is setting these themes. Pillar number 2. This one is not going to happen every single year going forward. In the past, I would say for the past maybe 10 years, there has usually been a new stock that I purchase each year, or at least each other year. The challenge now is I have 37 stocks. I can't do it anymore. I don't want to dilute or diversify too much. And so I'm happy with the 37. That said, I did add a new position this year. I added General Mills. I'll link to it in the description below, my whole analysis as to why I did that. I feel like it's a deep discount. It's a consumer non-cyclical, which is in my wheelhouse, and the starting yield is really good. When I have a new position, this will be pillar number 2, and I put $3 signs here, so it's less money than the $5 signs in bucket 1. The reason it's bucket 2 is it's kind of a good housekeeping rule. When I buy a new stock, I typically average in. I don't make a lump sum investment. I make a small lump sum up front, and then I average in each month or so to bring it up to size. Right now, General Mills, in terms of its weighting in my portfolio, it's small. It's the smallest position, and it's certainly smaller than my average for the small bucket, which is 1.32% of my total dollars. And so just to bring this up to the average small size in my portfolio, I have to keep averaging in. And for me, I like to be a good housekeeper. I like my physical house to be clean, but I also like my stock house, my stock portfolio to be clean. And so if I have this position, I decided to bring it into the portfolio. I have it there. I don't want it just to sit on the sidelines with a really small weighting. I need to make it a pillar. I need to make it within my strategy of deploying money to get this up to size. And I will keep doing so until I get there. And so this is something that I think about constantly, in addition to Procter & Gamble and Kimberly Clark, because it's really part of the theme now for 2018 is just bringing General Mills at least up to the average small size. But personally, I actually probably see this getting more to medium size over time. So I'm going to be averaging for quite some time to bring it where it needs to go. So pillar number 3. I've done some videos here, and you see from time to time, some of the examples have been Realty Income. Another one has been Southern Corporation. Again, I'm going to link in the description below. There's going to be a lot of links down there this time. And the market from time to time presents opportunities. And this is what's beautiful about having a more established portfolio. And personally, I find it a lot more fun building a new portfolio is really fun, but once you get to kind of more established portfolio, for me at least, it's more fun because when you own 37 stocks at any given time, there will be several stocks on sale, maybe even more. And right now in 2018, some of the stocks that are on sale in my portfolio, obviously Procter & Gamble, Kimberly, in my opinion, and General Mills, but certainly Southern Company and Realty Income. Both of those kind of fall in the medium bucket. I would say Realty Income kind of at this point has the dollar amount behind it that almost gets it into that core bucket. I don't necessarily want it to be core, I want it to be medium. That said, things aren't always perfect. It will normalize, it will get there over time. And the fact of the matter is, I believe the market is giving me a gift right now. It's giving me a gift of a deep discount on these two positions. And so I have been averaging into them this year. And I only put $2 signs here because I think the magnitude is really important. I stay focused on my strategic goals. I stay focused on bringing General Mills a new position up to size. With any money that I have left over, I will go into those current opportunities. And it may not be a lot of money, but what I found when I have 37 stocks in my portfolio, I can make these one-off buy orders once in a while. I can average in small amounts, and if something is on sale, I'll typically try to take advantage of that great opportunity that the market is giving me. And so that's kind of my third pillar for buying stocks, which stocks to buy. The last one, and I haven't really done one of these before. I'm going to probably do a video in the future on my YouTube channel about this, but there are certain stocks I own in my portfolio. Typically, they're smaller stocks, they're smaller positions because my core focus is dividend growth stocks, stocks that can grow the dividend over time. And also, when stocks grow the dividend over time, it generally means the revenue is growing, the earnings are growing, and the overall share price is growing. So they're stocks that are on an upward ascendancy, and the company is actually growing in size. However, there are certain companies I own in my portfolio, again, typically in the smaller bucket, and I like to call them trading range stocks. These are stocks, maybe they're slowly going up over time, but typically they kind of trade within a range. And they go up in the range, they go down in the range, but they're usually bound by a range. And some of these stocks, or most of these stocks, typically pay a very high current yield. Why would I buy a stock that's just in a range? It's not really going anywhere. I do it because I love the company, and I do it also because the yield. It's just a phenomenal yield. And I own 37 stocks. Some of them are higher growth than others. And sometimes I like the lower growth stocks because I can get more current yield out of them. And if I wanted to take advantage of my dividend stream tomorrow, I could do that. And it makes it a little bit more easy having some of the high current yielders in the portfolio. Anyways, I got some of these stocks that are in trading ranges. And when the trading range stocks typically dip towards the bottom of the range, making the current yield really high, I like to buy them. I like to average into them. And so I only put $1 sign here. I don't prioritize this. Again, this is my small bucket, so I don't want to prioritize the smaller stocks in my portfolio, those that I don't anticipate being a huge position in the portfolio. That said, they all play a nice assisting role. They play their role. They do their work for the overall portfolio. They're good team members. And if one of these trading range stocks hits the bottom of the range, I will try to buy some stock. I won't go crazy because I want to keep them a little bit smaller, but I will try to average in and take advantage of those buying opportunities. And so what's really helpful about having a framework like this is it really balances, in my opinion, logic and emotion. In the world of investing, one of the greatest challenges that I think a lot of people make is they go either too heavy on one side or the other. And on the emotion side, for example, if you've tuned into some of the popular TV programs, all of the bells, the buzzers, people trading on the floor, all of this excitement, it's that trading mentality. It's like buy low, sell high. It's a lot of noise, and a lot of people can get caught up in that emotion. They can get caught up, I want to buy something, I want to sell it the next month and try to make a lot of money. And so in my opinion, that creates a disadvantageous scenario for a long-term investor, for someone who is investing for dividends and cash flow. That said, I don't want to completely discount emotion. I think emotion is important because when one is investing for dividends, to reach one's goal of having a sizable amount of passive income that can either pay for all of one's living expenses or a good portion of them, it takes decades, it takes time. And to stay committed to the strategy, to stay committed to particular stocks, it requires some emotion. It requires some attachment to those particular companies. And so I like this strategy because on one hand, it's very logical. It allows me to think ahead of time of what I'm going to do, and it gives me a great selection amongst my whole portfolio of 37 stocks, so it's very logical. But at the same time, there's some emotion in here, because again, when I'm picking these strategic pillars, how did I pick Procter & Gamble and Kimberly-Clark? Could have I picked two others? Probably, but I picked those because logically I liked them, but emotionally I like them as well. Similarly, with General Mills, would have I bought that stock if there wasn't some emotional attachment to it? Probably not. I emotionally like the stock, but logically it checks up as well. So on and so forth. And so I feel like this strategy, it keeps the emotion in there, which I actually think is important, but it dampens it a bit, and it makes the fundamental logical side of things really apparent as well. So it works for me. It's how I personally decide at any given time which stocks I want to buy in my dividend stock portfolio. So thank you for that question today. Really, really enjoy the subscriber questions. Before I leave today, in terms of full disclosure, I own the stocks that are in the analysis today. So I am long on Procter & Gamble, Kimberly-Clark, General Mills, Southern Company, and Realty Income. And also Coca-Cola, actually, I want to talk about that in a minute. But basically, ticker symbols PG, KMB, GIS, SO, O, and KO. I am long on all those stocks. And in terms of a disclaimer, this is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please consult a licensed investment advisor first. Now, before I leave, actually, speaking of Coca-Cola, I'll link to it again. A lot of links today in the description. I just did a video about Coca-Cola, and this is a stock I own. It's a core stock. I'm not buying it right now. Let me rewind all the way to the beginning of this video. New portfolio versus established. If I were building a new portfolio right now, maybe I would consider averaging into Coca-Cola. It's a core stock of mine. I love the company. I did a video. Of course it's in my portfolio. It's that quintessential dividend stock. And so maybe if I were starting over, that's where a new portfolio is different than an established, hypothetically speaking. But an established portfolio right now, Coca-Cola doesn't fall into my strategic pillars. It doesn't fall into my strategic theme. It's not a new position. It's not a current opportunity. It's certainly not a trading range stock in my opinion either. So it just doesn't make the cards for 2018. Maybe it will in 2019, 20, or 21. We shall see. But I wanted to bring up that particular stock as well because I think it's a good example that shows the different thought process that goes behind new versus established, and how a stock may make sense in a new portfolio but might not make as much sense to average in more in an established portfolio. Thank you so much for watching today. I will see you all in the next video.